Okay, in today's short video, we're going to discuss why losing $10,000 in 2 days feels good. Okay, so we lost $1,000 on Friday, and we lost about 6 or 7,000 on Thursday. Now, that would seem like a lot of money to most people, losing 10,000 roughly in 2 days. But here's the thing, 0.16, you see that? We are only down 0.16. Look at the market. The market was down 0.61, so we beat the NASDAQ. The S&P was up 0.22, Dow 0.5. So we were right in line with all of the indices. That's what you want on this channel since we're using leverage. This 200K leverage that we always discuss. You don't want to endanger yourself and get into a margin call. So you tie all of your leverage and investments to the indexes and not risky stocks. Stocks, you never know what they're going to do. But the index, even if it drops, it will always come back. A stock may never come back. So when you go into our performance and value, you can see that even though we're just collecting dividends, we're still up 28% for the year versus the NASDAQ up 13 and the S&P up 7. So most people think that this is a boring strategy, investing in dividend-paying funds that pay you $95,000 a year, like we're about to show you here. But it's not boring because you get your yearly income paid monthly, as you see below. See all of our past videos and all of our dividend payments and why these funds are so good and why we rely on them so heavily. So you see those monthly dividends, you see the performance and value we have, and yet people think this is boring. They think that they can only make money in the Bitcoins of the world or buying options. They think that selling options down here like we do is boring. Look at all the premiums we've collected. Just a quick tangent. We've collected 30 to 40 grand in premiums, maybe even more. Do all these adding, add up all these columns here, $9, $17, $11, that's $1,700, $1,100, $700, $1,600, but times two, so that's $3,200. Do this math throughout, and you'll see that this is about actually 40 to 50 grand in premiums, which option premiums, which knocked down my margin by 40 or 50 grand, and that's exciting. And people just want to buy the stock and be risky. Look, I've done past videos on Tesla. We're up 60% on Tesla, and we don't even own the stock. We sold the put at $50, so it'll never get there most likely, and most people are playing at around $100 or $200, but we received $800 just for selling a put at $50 that'll never get there. Yet we get the exposure of a Tesla. So this is the exciting way to invest. You just pile your leverage into these dividend funds that are linked to the indexes so that you don't have surprises. 0.16, that's not a surprise. Even though you lose 1,000, which might seem like a lot, or 10,000 in 2 days, we're just in line with the market. And I just showed you the performance and value to prove that we're in line with the market. In fact, we're beating the market. So every day, as long as your performance, your percentage, not your dollar amount lost, but your percentage lost, as long as that lines up with the indexes, you're doing good. So even when you lose 10,000, that's good. You're in line with the market. The market's got to ebb and flow. You got to make money and lose money, and so you have to stay in it for the long haul. And this is how you stay in. You measure it by percentages, not by dollar amount. So that's good. The second reason why we feel good about losing 10,000 in 2 days is because we don't care about the day's gain. We care about the cash flow nature of these funds. So some of these funds pay 20% dividends. Some of them pay 10% dividends. Let's look at JEPI. JEPI pays roughly a 10% dividend. We have 20 grand in JEPI. We made past videos on JEPI. So JEPI with a 11.8% dividend, that means that let's just round it to 10. So 10% dividend times 10 years, that's 100% gain. So it doesn't matter what the vehicle is. It doesn't matter if you're trading JEPI, if you're trading Bitcoin. When you're trading a 10% yielding vehicle, it doesn't matter what the fund is. It could be the worst fund in history. I like to go with 4 or 5 star funds, but just know that if you have a 10% dividend, 10 years, it's paid back, it's cash flow. So no matter what the market does, you're going to be cash flow positive in 10 years. So that's what I'm doing. I'm spreading out all my risk into all these different dividend yielding vehicles, 10%, 20%, 10, 10, 10, 10. I usually don't like anything below 10. So these are all about 10. The stocks could be lower, but that's why I have a smaller amount in the stocks. Plus, you never know what a stock's going to do. So I keep 10% vehicles everywhere to minimize my risk of one hurting me. So if I spread it into all these different names, odds are that if one kills me, it won't take down my whole portfolio because we're so well diversified. Now, we do have most of our money concentrated here in the top in these two funds, 400,000 in the cornerstone funds, but they are linked to the S&P and the NASDAQ, and they are the highest quality funds in here. They're 4-star funds, and they made more money in the last 10 years than an SPY or any of these other 5-star funds did, like Gof. Gof is 5-star, Cornerstone is 4-star. We did videos on those, see our past wall. But Cornerstone made more money than Gof, so that's why we prefer Cornerstone. Also, Cornerstone's linked to the indexes. Gof is linked to more bonds and some equities. So you like to tie most of your money and leverage, especially margin. You like to tie it to the indexes. Okay, indexes. That way you don't have any surprises and you know they're going to come back and you won't get hurt much on a down day. And if you do, hopefully it's just in line with the percentages of the market. The last thing that I want to say. So first, we noted that $10,000 feels good losing it in 2 days because we are in line with the market and we're actually beating the market. So as long as the percentages are good, that's all we care about. 0.16, that's the percentage. The second reason why losing 10,000 in 2 days feels good is because we're not going for days gains. Yeah, well, we made $50,000 last week. Every day we're up 10,000, 10,000. And see our past videos if you don't believe me. But that was just icing on the cake to our 95K year in dividends. We don't care about days gains or losses. We just want the percentages to be in line so it doesn't surprise us or ruin our margin or our leverage techniques that we're using. So A, we're beating the market by percentages. B, we're playing the cash flow game. So it doesn't matter what these vehicles are. You just buy whatever it is. You don't even care about the ticker symbol. That just helps. And then they give you better performance, of course. But if you have a 10% dividend, again, 10 years, everything's paid back. It doesn't matter what it is. And then the third reason why we like losing 10,000 in a day is because it simply provides more buying opportunities to make your fortune and increase your monthly income. So we added to some things on Thursday and Friday, very, very small amounts because the market has not pulled back enough. If we go into a chart and look at the market, you'll see that, yes, we've had a pullback, but it's not enough. We need to get, to the 50-day moving average for the pullback to be good enough for top traders. That's what they peg their machines to. When you break out of this orange line, they all program their machines to buy long the S&P and the NASDAQ. And then when you have the pullback, they will then look for the next best entry point to start buying. Since we broke above this 200-day moving average, it's bullish, I'm telling you. And we also got across through. These black and brown lines have crossed through that 200-day moving average, the black being the 10 and the brown being the 20. But we want to get a pullback to the 50-day moving average or the 200-day moving average. So the 50 would be the purple and the 200 is the orange. See, 50 is the purple, 200 is the orange. If you can get a pullback to the 200 and then the 50, the purple pulls through and crosses up through the orange, just like the black and the brown did, you're going to have a very strong technical setup. And that's when we're going to buy. But we're going to make another video on when we're going to specifically buy more, but also look at the VIX. This will tell you when to do some buying. And it's spiking, but when the VIX is low, time to go. When the VIX is high, time to buy. So when it gets to the 25 or 30, that's where we're going to start buying more because that's about the range, 35 that you see market bottom. These tops correspond with market bottoms. These bottoms correspond with market tops. But you can have the VIX run at 20 for a long time and nothing happens. See, here at 2016, when we had a big bull market, the VIX stayed in the 20s, stayed in the 20s, stayed in the 20s. So we needed to get up to the 35s or 40s for me to really do some buying. But for now, all systems go. Everything is just riding steady sideways in the 20s on the VIX. Our percentages are in line with the market percentages here. We're playing the cash flow game anyway. 10% for 10 years is 100%. Cornerstone, 20%. And 5 years is 100%. So these payback periods are quicker than real estate or any other thing any other business that I know of. And then our performance and value speaks for itself. So those are the three things that we like about losing $10,000 in a day. It's in line with the market. We're playing the cash flow game anyway, and it's giving us an opportunity to buy more and amass our fortune. Stay tuned for more videos. Thanks.